I do like to start off each week with a summary of what I saw happening with the stock market this week. I'm going to use a little bit of a different view here because I've got some charts that are a little bit dense, so I want you to be able to see everything. This first chart is just the S&P 500 so far this year. If you look right here, the last 4 bars, because this is a short week with the holiday on Monday, really we've just gone sideways this week, which I see as really kind of a victory altogether since we had such a big run. If you see that low point that's right here off of my hand, all the way up to the high that we had close of Friday, that's over 9% run. That's a really big run in a very short period of time. And that's why, we want to stay invested in these markets at this point in time, just because these runs can happen so fast. If you're trying to get in and out, you can easily miss out on lots of them. This week has been very interesting in the sense that we've had what I consider some fairly good numbers, but the market has reacted all over the place about them. And the articles that are out there are kind of all over. I'll give you an example. So the number of job openings report came out this week, and it was down from the all-time high. And not a lot, but a little, and the direction is really important in my opinion. And the job openings is one of the things the Federal Reserve is really focusing on because they feel like there's too many job openings versus how many people are unemployed. It's almost 2 to 1. There's 11.5 million jobs open now. It was 11.9, so things have come down. But there's one side of the market that thinks it hasn't come down enough, that means the Federal Reserve is going to have to get more aggressive. And another side of the market that says, wow, it's coming down, things might be slowing down too much, etc. I think you need to have a slowing of the economy and a slowing in certain areas. And man, this week we saw a lot of things I think show some slowing, but not too much. And that's exactly what I'm looking for. So we saw the wage increase, the hourly wage increase actually slowed down, which I think is important because you can't have wages go up and up and up and up because that creates inflationary environment because they'll eventually pass that along to us in terms of cost. We saw the number of new jobs created that came out today, 390,000, was higher than expected, but quite a bit lower than last month. And so the market's down today because it was higher than expected, and the market's afraid that means the Federal Reserve is going to have to get more aggressive. But I'm looking more at the trend. And everything that I'm looking for in terms of pieces slowing down, and I think at reasonable rates, is happening. Between May and April and March, we're starting to see peaks in inflation and all of these different areas. It's exactly what we need to see. I would assume right now that the Federal Reserve is pretty happy with what's happened, because most of what happens for the Federal Reserve is they do something and 6 months later the economy kind of finally reacts. So what we're looking at right now is what's been done in November, which is when they really started talking about raising interest rates. And so as we go, they started raising interest rates in March, and so maybe that'll be impact in September, et cetera. There's a lag. And I think they'd be satisfied to see what has happened so far as that goes. So again, market is hanging in there. Is this going to be a recovery or a short-term bounce and we get back down to these lows and maybe even lower? That's the big question. I do think that this week I'm very satisfied with at least a sideways motion after a 9% run back. We didn't give it all back. We didn't continue to run up and stretch the rubber band too much. A pause here I think is very positive. It's also a holiday week. Be super careful of trying to, analyze what's happening during a holiday week because the volume can be very low and you can have a lot of different weird things pushing the market as far as that goes. I do want to present some of the indicators that I'm using to look forward at a recession. And I have 3 here that have demonstrated in the past some very good predictive ability on future recessions. And I think that's the difference. If this market kind of is able to hang in there because the economy doesn't go into recession, we might have already set our lows or be very close to them. If we have a recession, the market could go down a lot farther. So the focus, in my opinion, right now is recession or not. And so one of the key indicators I use, I've presented this multiple times, I won't spend too much time on this, but is a leading economic index. This is a basket of 10 different indicators. And you can see the gray lines are recessions. It's had a very good predictive ability, 18 months before, 11 months before, 21 months before the big recessions that we've had here, in the last 20 years or so. And so Right now, it peaked in March, came down a little bit in April, but it has to come down more before we can call that a peak as far as that goes. So still no signal here of a recession on an early basis. And then I'll show you a couple of others that I use. This is actually done by the New York Fed, and they take the 10-year Treasury yield and the 3-month Treasury bill yield. And what they're looking for, and the 3-month is actually a special, it's a secondary market. The 10 years, the constant rate. So I won't get into weeds as far as that goes. But essentially what they're looking for here is when the 3-month pays more than the 10-year, the bond market is signaling a recession. And it's very, very accurate, especially if that negative scenario lasts for 3 months or longer. And if you look back at this, you can see where it crossed through zero quite a few times right before, within 12 months a recession happened. So very good indicator to use, very popular indicator as far as that goes. If we look at it right now, it's going straight up. What that means is it's not going to zero. We're actually going away from inflationary pressures when that line is going up. Now, one of the things that the New York Fed does, which I really like, is this chart here. And this is the probability of a U.S. recession over the next 12 months, looking at the 3-month and 10-year yield. So what they've done is they've gone back to 1959, and they said, okay, whenever the yield is at a certain spot, what the differential between those yields, what is the how often did a recession happen? Now you can see this right over my shoulder. Oops, wrong way. Right over my shoulder here. We're actually down to a 3.7% probability of recession right now. So actually, it's the end of April, but it didn't change much for May. We'll see what happens when they come out with the new numbers. But nonetheless, very low probability of recession is being indicated by this very accurate historical yield spread. So consider that. So leading indicators aren't showing a recession yet. 3-month to 10-year yield, not really showing a recession yet either. And then this is a lot of data here, but this is from a company called ClearBridge. This is 12 different indicators that they've identified, and I really like this breakdown. They do a little green arrow if the indicator is still not showing any recession in 12 months, a little yellow circle if there's some, caution, it might, be getting closer to showing, or a red X if it's basically that particular piece. And, they have housing permits and job sentiment, jobless claims, retail sales, growth in wages, price of commodities. ISM new orders has to do with manufacturing new orders, profit margins, truck shipments, credit spreads, money supply, and they have the yield curve in there, right? So that's, again, you'll see that in a lot of these. But I do like these baskets, and they have a green arrow here at the bottom for their overall signal, and you can see it by month. So, for example, in March, we had just one red X and one, yellow circle, and now we have 3 yellow circles and 1 red X. So we're closer to a recession in this particular indicator, but still pretty far away. And one of the things they do that's really nice is they do this chart where they do what they call a comparison. So current is the farthest one over that we just looked at. And then they've got all the different recessions, 2020, 2008, 2000, 1990, 81, 80, 73, 75, and 69, 70. If you look closely at these, you can see how many red X's and yellow circles there were 12 months prior to the recessions that happened historically. We're nowhere near that right now at all. This would be a very unusual recession. It's possible. It's a very unusual time frame, but at least this indicator is also showing similar to what we saw with the Treasury yield, similar to what we saw with the leading economic indicator. We're not seeing big, pushes right now on the early indicators towards recession. And so that's why you got to be careful about jumping in and out of the market or shorting it or going inverse, because the average downturn for the S&P 500 since World War II without a recession is 15%, and the average downturn with a recession is 36%. I mentioned those numbers a lot. And so really the core thing now is, are we heading towards a recession or not? That could happen. I could be saying something different a month or 2 months from now, but that's not what we're seeing right now. We are seeing a slowing, but that's what we need to see. It's just a matter of the pace of that slowing. Does it kick us into recession or just bring us down enough to kind of fight inflation, right? So that's what we're looking at the moment. Things are okay. I know that, there's a lot of different opinions out there, and there's certainly a lot of articles talking about the impending recession, but that's partly because those get a lot of clicks. And so anyway, if you look at the real data and some of the indicators that are leading, I think it's worth, noting that there's an awful lot of them that show that there's not a recession coming in the next 12 months at this point. So something to watch as far as that goes. So nonetheless, I want to thank everybody for watching the summary this week, and I look forward to talking to you, again about it next week.